Derivatives have a long history that dates back to ancient Babylon. They are tradable financial contracts with an underlying asset that give them value. Today, many financial markets, including the cryptocurrency industry, incorporate derivatives. Futures are a particular kind of derivative contract wherein a buyer and a seller agree to acquire and/or sell a particular underlying asset, like a cryptocurrency, at a predetermined future date for a predetermined price. The buyer is required to pay for and get the asset when the contract expires on the designated future date, and the seller is required to sell and deliver the asset. In this video, we will discuss about the crypto derivatives and futures in details. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So, watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So, let's begin the video. Actual physical delivery of the product is not required in today's modern financial and cryptocurrency markets, where futures can be leveraged to get exposure to price swings of an underlying asset. Instead, the trader's account would be updated with the profit or loss that resulted from the transaction. This is sometimes referred to as cash settlement. Long versus short: when you buy futures, you're said to be taking a long position, and when you sell futures, you're said to be entering a short position. When the asset's market price at the expiration date is higher than the specified price, long bets are profitable. When the market price falls below the predetermined price, they suffer a loss. Conversely, short bets make money when the market price at expiration is lower than the specified price and lose money when it is greater than the set price. Margin: because cryptocurrency futures are traded on margin, traders do not have to cover the entire cost of the trade themselves. In its place, a portion of the money is borrowed from the trading platform or exchange. This makes it possible to use leverage, which could increase gains but also increase losses. Additionally, the trader can be subject to forced liquidations and margin calls. Perpetual futures: these are an exclusive sort of futures contract for the cryptocurrency market. Futures work similarly in terms of mechanics, however perpetual futures don't have an expiration date. The contract can be held by a trader for as long as they like, up until the point at which they decide to close the position or are compelled to liquidate it for other reasons, such margin problems. If you are still watching this video, don't forget to hit the like button and share your thoughts in the comment section below. If you haven't subscribed to the channel yet, please subscribe, as that motivates us to bring more videos like this for you. Uses of crypto derivatives. Derivatives are mainly used for hedging and speculating. Hedging. This kind of risk management tactic seeks to lower the possibility of losing an existing position. For instance, a trader may purchase Bitcoin on the spot market in the anticipation of price growth. The trader would prefer to limit losses in the event that the price of BTC declines, but they are also concerned that they could be mistaken. If the price of Bitcoin fell, a short BTC futures position would profit, offsetting the losses from the long BTC spot position. A long put option with BTC as the underlying asset alternatively might also help to reduce risk, because the long put would profit if the price of BTC fell. Speculating. In order to potentially earn from a wager that the asset price will rise or fall, one would enter a long or short trade. Gains could be increased because leverage is used in crypto options and futures, but losses could also be increased. Income. Futures and options are tools that traders occasionally utilize to make money. For instance, buyers may pay premiums to option sellers. A technique called funding rates is used in cryptocurrency perpetual futures, wherein long-term traders occasionally have to pay short-term traders, and vice versa. In order to receive this funding rate, some traders may open bets in crypto perpetual futures. Complex financial products known as cryptocurrency derivatives are frequently used by experienced traders. Depending on the trader's expertise, competence, and personal circumstances, they may or may not be appropriate. Conclusion: a derivative is a tradable financial product, including but not limited to cryptocurrencies, stocks, bonds, commodities, and FX, that gets its value from an underlying asset. It gives traders access to an asset's price fluctuation without actually owning the asset. Futures and options are two popular types of cryptocurrency derivatives, and they are primarily used for speculating and hedging. Share about your thoughts in the comments section below to let us know. See you in the next video. Until then, take care and stay fit in health and wealth.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.